please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to this special show. We are looking at the government's measures which have been announced yesterday evening amidst a falling rupee and rising fuel prices. Remember, the Prime Minister's economic review meeting is scheduled later this evening. And ahead of that crucial meeting, the government has announced 5 steps aimed at bringing in the much-needed dollar inflows. Here are the 5 steps which were announced yesterday. The first one, of course, is the mandatory hedging conditions for infrastructure loans are going to be reviewed. Secondly, manufacturing entities which will be allowed to access ECBs of up to $50 million with 1-year maturity. Number 3, removal of exposure limits for FPIs vis-a-vis corporate bond portfolio of a single group. Number 4, exemption from withholding tax for issuance of masala bond issuances which have been done in FY19. And number 5, removal of restrictions on Indian banks' market making in masala bonds. These have been essentially the 5 steps which were announced yesterday evening. Remember, at the heart of these measures, Friday's measures, is an intent to try and increase foreign capital inflows into the country, essentially trying to get more dollars into the country. And this the government hopes will be done by removing some irritants and impediments and signalling that India is open to foreign investment. Authorities believe that the measures are likely to bring in between $8 and $10 billion over time. To discuss this, what this would mean, whether this would be as effective as the government hopes it will be, we've got an expert panel of guests joining us. K.K. Mistry, Vice Chairman and CEO of HDFC, Nilesh Shah of Kotak Asset Management Company, as well as Sanjay Nair will be joining in. Later, we'll also speak with Ananth Narayanan, Professor at SP Jain Institute of Management and Research. Jayesh Mehta, Managing Director and Country Treasurer at Bank of America, will be with us as well. Let me go straight across to Mr. K.K. Mistry at HDFC to understand what he's sort of making of these moves. Mr. Mistry, thank you very much for joining us. First up, broadly, what do you make of the measures which were announced yesterday evening, sir?
I think these are all positive measures. A little more could perhaps have been done, but whatever has been done by itself is a very positive measure.
Mr. Mistry, do you believe these measures will help in the very near term, immediately?
I don't think this will help immediately, but in the medium to long term, it will definitely help. See, I think a couple of other things which could have been thought through, or which could have perhaps been done, which would have made masala bonds more palatable or more easy to access. One is the current period. The period for a masala bond earlier used to be 3 years, which was a year ago or so raised to 5 years. Now, the demand really is more in the 3-year category, not in so much in the 5-year category. So if that could be reduced to 3, it would be a great help. And the other thing is that the ECBs up to $750 million fall into the automatic route. So you don't need to go to RBI for specific approval. But masala bonds do not fall into the automatic route. So you have to go, to the best of my knowledge, to RBI for getting approval. So if this also up to a certain limit, say 5,000 crores or some such amount, is made free, then it would be possible to get the money faster. So if you want quicker action, then I think the process of getting the approval could be done away with. It should fall in the automatic route.
Mr. Mistry, what is the motivation, according to you, to tweak the rules with regards to ECBs at this point in time? And do you think they'll help?
Well, every little bit helps. It improves sentiments. It shows that the government is being proactive. So to that extent, it is positive. As I said, a couple of more things could have got done. Even more things could have been done on the ECB front, which could have helped faster and quicker inflow of money into India. It would not mean major changes in the existing laws, but some minor tweaking would have helped a lot. Like, for example, you take any external commercial borrowing. When a company does an external commercial borrowing, there is a compulsory requirement to switch from a fixed rate loan, from a floating rate loan into a fixed rate loan. Now, when you go to the syndicated loan market, all the money you borrow is on a floating rate basis. So converting fixed to floating becomes, converting floating into fixed becomes an increased cost to the borrower. Now, if a company is willing to take the floating rate risk, or it's got assets which are floating rate, then there should be no requirement to convert that floating rate liability into a fixed rate liability.
Those are important points that you're making, Mr. Mistry. So more tweaks would have helped. One particular criticism which we've heard from some quarters is that these measures usually work and are announced when you have the currency which is rising. For example, with masala bonds, foreigners are the ones which take the foreign currency risk. Will these measures work at a time when the currency is going the opposite way?
I think these measures by themselves may not work as effectively, but if these are supplemented with some constructive effort by the government or some confidence is given to the market that the government is making all possible effort to stabilize the rupee at these levels, then it can still work. So, for example, there was some mention by yesterday that certain imports would be curtailed and certain exports would be encouraged. So I think these, if you can get the trade deficit a little better in our favor, and that would also go a long way in strengthening the rupee. So one way to strengthen the rupee is to get foreign currency into India, and the other way to strengthen the money is through fundamentals. Fundamentals means less of imports, more of exports and stuff like that.
And Mr. Mistry, do you expect some of these measures that you're talking about to come in quickly? For example, import curbs, etc.?
Today they have a meeting in Delhi. I'm sure there will be some measures which they will sort of look at. Now, if you want to look at it from a long-term point of view, we should be encouraging electric cars. So less of petrol is, or less of oil is imported. Our biggest problem really in India is oil. Our single biggest problem is oil. If we can resolve the oil issue, if we can reduce the import of oil, that would go a long way in stabilizing currencies, reducing inflation, improving the current account deficit, and go a long way in restoring confidence.
But those are longer-term sort of measures which would be required to reduce the import of oil. But starting Monday, do you expect the RBI to act? For example, taking the oil demand off the market, OMCs deal directly with the RBI.
I'm sure. That is also one of the things which the RBI can definitely consider. They got $400 billion of reserves, as I said. If they can permit the oil companies to purchase their oil requirement directly from the RBI coffers rather than go to the market, it to a great extent reduces the demand for dollars from the market. Great extent.
Mr. Mistry, appreciate you joining in, sir, and thanks for adding some perspective to the measures which have been announced yesterday. So the sum and substance, as Mr. Mistry is pointing out, by themselves, what has been announced yesterday will not do the trick, but more supplementary measures will be required, both on the domestic macro side and adjustments by the RBI, which are very much expected. Nilesh Shah of Kotak is also with us, Kotak AMC. Nilesh, thanks very much. Great to have you with us here. You heard some of what Mr. Mistry said. Your own sense, Nilesh, will this help? What has been announced yesterday help in stabilizing the rupee market?
I completely agree with Keki that these are measures which will kind of stabilize the rupee only if we take other supplementary measures. And just to expand on what Keki was saying, clearly we have three problems in relation to FX outflows. One is oil. We have spent about $110 billion on an average over the last 10 years in terms of oil import. The second one is gold import, which we have reduced substantially, but it is still large. And the third one is electronic imports. Electronics have reached beyond gold in terms of to become our second highest import. And the pace at which it is growing, it can eventually overtake even oil imports. Now, oil we have to manage on a longer term basis through exploiting solar energy and converting our internal combustion engine motor cars and vehicles into electric vehicles. Electronics, like Samsung created the world's largest mobile handset factory in Noida, can we do that in color television, refrigerators, and other consumer durables and printers and cartridges and so on and so forth. So we need more of Samsungs to come in India and set up large plants in India so that our electronic imports can be controlled. The gold bonds have succeeded a little bit in controlling gold imports. Now, can we popularize gold bonds and create more financial innovation so that money which is going towards import of gold instead of going abroad, continues to remain in the country.
Right. Got it. Nilesh, absolutely sound points you're making. Let me bring in Jayesh Mehta into the conversation as well, Managing Director and Country Treasurer at Bank of America. Jayesh, thanks very much. Your first thoughts. I mean, how effective are the 5 measures which were announced yesterday going to be by themselves at this stage?
Maybe I would say it's clarification, I would say. Not clarification, but it's more enablers. So that should be good. But I think the message is, okay, it's not showing too much of panic. They've put in enablers, and I think they are looking at it. So I think that's a good message, rather than doing a panic reaction, which was not really required at this juncture. Because a lot of people were expecting immediate great monetary measures and stuff like that, which does not really, at times does not really help India as such on currency, because generally we take that as a theoretical standardized practice that you raise rates, and like what we did in 2013, it's actually harmful. So to that extent, it will be good, but yes, I think that that does not mean that we may not depreciate. We will definitely now move in line with the rest of the emerging market, and dollar strengthening will impact us, but not as like we were depreciating more. Like if you look at
so you're saying the potential for extra weakness has been taken out of the system.
Absolutely.
So in a way, with these, you'd say speculators will back off. Jayesh, you got the pulse of the market.
They will still try, but that's maybe 1 or 2 days, but definitely not with that vigor which was there earlier. It was like, I think last 7 days was the worst, right? Basically from 3rd September, every day you see a lower closing for rupee. That encourages traders to continue the side, right? So it was more momentum rather than anything. So that momentum is broken for the time being.
Jayesh, hold on. Nilesh of Kotak is also with us. Nilesh, do you expect more later this evening?
Definitely. There are clearly 3 things which we need to tackle on a medium-term basis. One is our trade deficit with China. I mean, clearly, official number is about $52 billion. If we take into account Hawala transactions, it might be $60 billion. We need to reduce our trade deficit with China.
Do you expect that to be tackled today? Do you expect that to be on the priority for the government?
They have said that they will announce measures to control unnecessary imports.
Okay.
And I think there are many items from China which is probably better made in India rather than imported from there.
Okay.
The second thing which government should focus on, and again, I don't expect announcements today evening, but due to tariff war, the supply chain is getting disrupted all over the world. We have a great opportunity to get into the bus, which we have missed for last many decades. Today, when we read international papers, they are talking about supply chain disruptions from China, and they're looking at countries like Cambodia, Thailand.
So basically, you're saying trying to tap the export markets, take advantage of this disruption caused by trade spats.
I mean, go and get more of Samsungs to set up their supply chains in India, giving the lure of domestic market. We have a large domestic market which Cambodia, Thailand, Vietnam, Bangladesh does not have. Can we go and capture that? For example, in ready-made garments, our total garment export is $17 billion. For China, it is $250 billion. For Bangladesh, it is $25 billion. We make cotton, we make yarn, we make fabric.
So we should be able to
stitch into garments. Now, go and get that supply chain equations into India.
Let me take that to Jayesh as well, Nilesh. Jayesh, do you expect measures later this evening?
Yeah, so it's I'm just looking at that. They don't do anything dramatic, but I think this is definitely required, which is you have to manage your imports, unnecessary import, and you need to have some tariff. Make in India is what you need to really drive by, reducing and putting some tariff there. And of course, if China is losing out, we should try to capture that rather than letting go to Vietnam and stuff like that. So. But I am not sure whether, unless they had done their homework and they are ready with it and then announcing it today, right? So
maybe a sort of intention or and that kind of thing could be announced, but actual formulation of policy will take time. you're saying, Jayesh.
Yeah, because they would be making their industries or whatever it is.
What are you expecting from the RBI from here, Jayesh, starting Monday?
So I think they have been there. See, they have been there in the market, but they were not really. I think, as you see, one of the recent, we have this Lehman series going on, right? And as like Dr. Reddy said, like when you think that it is speculative and it is momentum driven, right? You have to hit it at the right time. You have to surprise it, right?
Do you expect intervention to increase? I mean, heavier intervention, direct intervention, and maybe taking the oil demand off for starters?
That is something, I think normally it should have been done, like if you look at it earlier, RBI normally does it much earlier, right? This time they haven't done it to that extent. Even yesterday we saw some of the, oil demand coming to the market. I think maybe it's philosophically whether you give it directly or let them come to the market. Does it really make an impact? And maybe the current thought is like, more market, more matured situation. So rather than knee-jerk, but yeah, you might do it temporarily. That's a different story.
Nilesh, 30-second response. How will the stock market take these announcements?
Difficult to say because clearly Rupee is not the only factor driving stock market.
Okay. That is 15 seconds. You got 15 more, Nilesh. Use that. No, I mean, if the rupee stays where it is, as Jayesh says, the extra weakness is taken out, do you expect, I mean, both feed off each other, right? I mean, the rupee stock markets and vice versa. Do you expect stability here as well?
See, stability of rupee will always encourage some flows which are on the side. Suppose if you were an FI and you see rupee crashing 1% a day, then obviously you are going to delay your purchase order. But when you see rupee appreciating 1% a day or the chain of depreciation broken, as Jayesh mentioned, then obviously you will resume your normal activity. So to that extent, one can see better participation of people who were sitting on the fence to start investing into the market.
Nilesh and Jayesh, thanks very much. Both of you. Appreciate you taking out the time and speaking with us here on CNBC TV18. Well, we're going to take a very quick break. But before we take that break, here is what the Economic Affairs Secretary, Subhash Chandra Garg, told CNBC TV18 in terms of what impact the measures which were announced yesterday are likely to have. Listen in.
In the present circumstances, at the current level, going beyond what we witnessed last few days was enough to consider something at which there has to be.
So 73 in that sense is the threshold then, if I can ask you bluntly.
I won't specify any particular number,
okay.
But the reason that there's been a discussion, review of the situation when it reached a certain level would indicate that the government would consider anything around that or beyond that to be unreasonable levels. These 5 measures would definitely have meaningful impact. It might, it's difficult to put any specific number, but I think it should have impact of about $8 to $10 billion. There is a constant review, especially on the current account side, exports and imports measures. Those would be, as I said, reviewed next week or something. So there would be a constant decision-making, taking into account the situation, and specific measures would be announced by the government.
Okay, that is the DA Secretary speaking yesterday evening to CNBC with CNBC TV18. We take a very quick break here. We are joined by Ananth Narayanan, Professor at SP Jain Institute of Management and Research. Sanjay Nair of KKR also joins in with their views on what the government has announced and what is expected later this evening and starting Monday from the RBI. Stay tuned. We're discussing the 5 measures which were announced yesterday evening, and we're looking forward in terms of what else may be announced later this evening or from the RBI starting Monday. We got you a whole host of views before we took that break, and now we've got one of the keenest watchers of the currency market with us. Ananth Narayanan is Professor at SP Jain Institute of Management and Research, and he's with us right now. Ananth, thanks very much. Great to have you with us here. I mean, the rupee did a sort of big bounce 2 days last week, and then we've got measures Friday evening. What do you make of it, prima facie?
Morning, Prashant. The measures by themselves, aren't earth-shattering. In fact, the NDF markets in New York last night weren't particularly impressed. Rupee actually closed above 72 in the New York markets. Essentially, the measures were of two types, right? You had on the capital front, you had the government and the RBI practically asking domestic participants and overseas entities to take a bet on the rupee with unhedged ECBs and with masala bonds and FPI. That by itself, at a time when things aren't looking great, I'm not sure how much of money that will come in. On the trade side, of course, there was a hint that there might be something against so-called non-essential imports. One will have to wait for what the details there are, but that will probably be more meaningful. This isn't elegant. This isn't aesthetic. It sounds clumsy to tamper around with trade. But at times like this, where our current account deficit is threatening to go into $85 billion or so, something has to be done. And maybe in areas of electronics, maybe in areas of gold, some kind of controls might be required. So we'll have to watch that particular space. But so far, at least, nothing earth-shattering. All eyes on what comes out from the Prime Minister's meeting today. In any case, I guess RBI will be there on Monday to protect the rupee, notwithstanding what happened in New York.
Will they be there in a bigger way? I mean, will the intervention be heavier?
I think so, Prashant. So look, let's be realistic. After a so-called Big Bang weekend, the last thing the authorities will want to look is to look foolish the week after. So I think there will be a use of reserves. So in the short run, I do see dollar rupee being capped at 72. So we've always said that the RBI and the authorities have plenty of ammunition to buy us time. So that trend can continue and I guess will show up in the short run. What will be important is that this time is used judiciously to address real structural issues which confront us. We have a problem on our current account deficit. Our FDI has not been looking great after the first couple of months in this fiscal. It's again gone down. So overall, our external sector is not looking great. We are having to borrow fickle, opportunistic money to pay for our oil, gold, electronics, and smartphones, and so on and so forth. That's not sustainable.
Ananth, one comment which was made is that we look at import, sort of making imports more expensive in certain categories, right? Taxation, etc., could be used. How will that be seen? I mean, can that be done at this stage?
So look, you could always put on tariffs on certain sectors, right? And I guess one of the sectors which people are looking at closely is electronics. Electronics, yes. Now, it's double-edged. And it's frankly, for a purist, for an economist, it's never a good idea to have too much of tariffs. The only person who seems to believe in it is Mr. Trump right now. In the long run, tariffs aren't sustainable. You will only have, backdoor channels and smuggling to bring in goods. And plus, you could also argue like things like smartphones actually is useful for us as an investment for education, for digital India and so on and so forth. But in the short run, we have a problem. I mean, let's face it, $85 billion of current account deficit with only $35 billion of FDI, which means we have a hole of $50 billion. And that trend seems to be deepening. Now, something has to be done to address it at a structural level as well as on an immediate level. So maybe temporarily having such measures might be contemplated. But, one hopes that eventually things like actually make in India, make for India, infrastructure, making the ease of doing business for exporters easier. Those kind of things hopefully will eventually take over rather than these short-term measures.
Ananth, so big bang measures, I mean, the bazooka measures, right? I mean, they are out of the window then, right? I mean, sovereign issue or NRI issuance or those kinds of things. Or you think those still could be on the table? I mean, sometime later
they're
if
not
needed.
Required now, Prashant. They're not required right
they're
now.
not.
These measures are essentially measures to enhance your reserves, right?
Yeah.
Now, when you're sitting with $400 billion,
you don't need
the last thing you want to do is to use it. It's like using a bazooka to kill a mosquito, right?
Yeah.
You don't do that when you have so much of reserves already. Of course, if things go bad, if we start to drop to $350, $325 billion of reserves, then we have plenty of other arrows to dip into from our quiver, right, in terms of measures to be taken. But using it right now would be complete overkill. These are not, you see, these are distortions. Doing an FCNR scheme and stuff like that.
And then you got to subsidize that, right? I mean, so there's a cost to be paid.
Oh, absolutely. So the 2013 FCNR issue was in the price range of U.S. Treasury plus 4%.
Yeah.
If we did a sovereign bond at that obvious rate, frankly, it would have raised several eyebrows, right? So it's a obfuscated hidden cost. It's very expensive. It pretends to be NRI. It's not NRI. It's actually bank money coming in as pretending to be NRI money.
Yeah.
So it's a distortion. It's to be used only under extreme circumstances like 2013. And we are not in 2013 as yet.
Sure. In terms of rates from the RBI, where do we stand? I mean, Turkey's increased, but I'm not comparing. Russia increased. That was a surprise move. Do you think that kind of move is needed or not really?
I do think the RBI has to be cautious, Prashant. So look, there is one school of thought which says that our RBI's mandate, or rather MPC's mandate now is inflation. And inflation is under control if we are in fact in the 3% handle. So what gives? Why should we be worried on interest rates? But I don't think it's that simple. You know, inflation is an outcome. It's not the cause. Now, as it is, because petrol prices have gone up and diesel prices have gone up, inflation expectations will go up. Second, we have a problem on the external sector. When that persists, and if we do have an issue of a fiscal deficit as well, which I suspect we will, those twin deficits will cause inflation eventually to shoot up, right? And thirdly, the nature of inflation, you know, the fact that we have 3% inflation is because of food prices being soft. It's not because of, you know, the core inflation being soft as well. Now, I don't know if that's good, frankly, having lower food inflation. So the nature of inflation is very, very different. Lastly, at a time of financial instability, when we have issues on the external front, when fiscal deficit is going to be a challenge, when our financial system across banks and NBFCs is looking as weak as it is, I don't think RBI can afford to be lax. It can't be behind the curve. So, you know, I would keep aside this inflation argument and plumb for the fact that we have to be cautious, we have to be austere, we have to bring down demand and ensure that our twin deficits are kept under control.
Ananth, it's a pleasure. Thank you very much, as always, for adding a lot of perspective to the news flow. Thanks indeed for joining us here on this special show. Well, it's that's it from all of us here. But stay tuned, and it's over to the meeting later this evening, which is being chaired by the Prime Minister, and, of course, outcomes which may come as a result of that meeting. Thanks for watching.